the dollar, but different currencies may tell different stories. That reflects the fact that each national currency is a paper asset reflecting the creditworthiness of the issuing government. In any case, exchange rates tell a lot about relative inflation, but they're not direct measurements of absolute inflation. It is better, therefore, to express the dollar's depreciation in terms of physical assets and not paper assets. We want to use commodities or precious metals or gold. But there are still two more obstacles to overcome. Different commodities also tell different stories. All commodity prices are susceptible to changes in the economy's performance, but some are more sensitive and others less. Precious metals, such as silver and platinum, are no exception. In fact, they're among the more sensitive metals or more sensitive commodity prices. So by a lengthy process of elimination, we are left with the price of gold as the single best measure of inflation. I believe it is the best measure for the purpose of making investment decisions in particular. Its price is set by the market. Ambiguity is at a minimum. It's sensitive. It's timely. It's a leading indicator of all the other symptoms and indicators of inflation that I've been talking about, and it's not vulnerable to a sag in the economy. So at one end of the scale, we've got gold, and at the other end of the scale, we've got the Consumer Price Index. And as we've already seen, consumer prices and the price of gold eventually converge, but the difference in timing is enormous, and that's shown in the next slide, figure 7. Figure 7 analyzes how long it takes for the U.S. Consumer Price Index to respond to a change in the gold price. Now, I have to explain this chart carefully. In the upper chart, we divided the history into years in which the price of gold rose and years in which the price of gold fell. And those two lines show the path of the Consumer Price Index. Obviously, the CPI rises much faster after the gold price has risen and much slower after it's fallen. And you can look at the divergence between these two CPI trajectories. It keeps widening for years, and towards the end of the graph, it appears to be approaching something like 28% eventually. 28% is the difference between the gold price scenarios. In the lower chart, this divergence is plotted as a function of time, suggesting that it takes more than 5 years for just half of the ultimate response to show up. Allowing for a difference of 5 years, in the next slide, figure 8, we are showing there the dollar price of gold and the US CPI really do move in parallel over time. This chart compares the 5-year change in gold with the 5-year change in the CPI. And the broken line depicting the gold price has been shifted 5 years to the right to bring the two lines into rough conformity. Next slide, please. People are far more aware of the effect on their lives of a rise in the price of oil, or in energy generally, than in the price of gold. Oil has an obvious role in the economy. It's far the most important of all commodities, and its price is the one that gets the most attention from investors and the media. If we were to use one single asset as a measure of inflation, many people might be inclined to use oil rather than gold. Gold is one of those commodities that gets in the news only when its price is changing dramatically, while oil prices are watched closely even when they're stable. But there are several ways in which the gold price provides more accurate information about inflation than the oil price. Correlations between oil price changes and producer price or consumer price inflation a year ahead are much lower than those for gold. You can see this in the next slide, figure 9. Furthermore, when oil price and gold price data are included in a single statistical test to anticipate inflation, it's only the gold variable that is statistically significant. Another way to test oil and gold against each other is to look at their implications for interest rates. Precisely because it anticipates inflation so well, Gold is also a powerful predictor of interest rates. The next slide is figure 10, and that demonstrates how unhelpful oil price movements are in predicting bond market performance. The bars show the responses of the bond market to different combinations of rises or declines in either oil or gold. The point to notice is that when gold has risen more than 10%, bond yields rose to the same extent regardless of whatever the oil price did. And in general, throughout the graph, it's clear that the gold price is the better measure or the better predictor of the bond market response. Going to the next slide, figure 11, we can portray a triangular relationship between oil, gold, and bonds. The diagram points out that the relationship between oil and bonds is roughly contemporaneous. Gold is correlated with both of them, but it moves in advance of both by a year. So what is it then that gives gold such superior properties? Unlike oil and other commodities that are produced only to be consumed, gold is produced almost exclusively for accumulation. Gold is different because the reservoir of it that is tradable in world markets dwarfs any possible interruptions in the annual flow that results from either industrial demand or supply changes. The annual flow of newly mined gold adds less than 2% to the accumulated gold supply, far less than for any other commodity. What the existence of this reservoir does is to stabilize the purchasing power of gold in terms of other goods. The gold is essentially always there, and it allows the gold price to be a good barometer of changing currency values. Ultimately, that means it's a barometer of changes in the absolute level of prices. But the main purpose of oil is the production of energy, and to use it for that purpose, it's necessary to consume it totally, literally to destroy it in the process of converting it to energy along with water and carbon dioxide. And that makes the real value of oil much more variable than the real value of gold. The relative variability of oil is visible in the ratio between the prices of oil and gold, which has been something like a natural constant. Many people watch it over the long haul, but it fluctuates, of course. The next slide illustrates the way that the price of gold has revolved around movements in the price of gold back before about 10 to 20 years ago. My conclusion is that the gold price reflects inflationary pressures in general, but the oil price also contains information that's specific to the energy sector. In short, the gold price is a reliable barometer of the value of the dollar, and the oil price is not. Next slide, please. So as a market signal, the primary role that gold can play is to detect and measure a change in the real value of the dollar and other currencies. But it also has a secondary role as a benchmark for valuing other assets to determine whether they are cheap or dear by historical standards. And the price of silver relative to gold is a good example of that. It provides a valuation indicator for silver. In the next slide, figure 13a, the graph shows the price ratio between the two metals back to the middle of the 19th century. Investors would expect that silver is much more likely to appreciate in price when its ratio to gold is historically low than when it's high. The following slide, figure 13b, confirms this, and it also provides an idea of how long it takes for the silver-gold ratio to reapproach its trend line after it's gone somewhere else. A more important application of the same thinking concerns the Dow Gold or S&P Gold ratio, and the history of that is shown in the next slide, figure 14. This is a history long enough to demonstrate that over the long haul, equity prices outperform the gold price, and we have to allow for that in figuring out the norm for the ratio. The following slide, figure 15, divides the history into groups of specific years according to how high or low the ratio then was relative to the trend line. The result is a very interesting but unsymmetrical pattern. The stock market performs superbly when it is extremely cheap according to this ratio, but the market does not perform particularly badly when it's extremely dear. So it's not a very straightforward valuation indicator. The following slide Figure 16 shows how long it takes for the stocks to gold ratio to reconverge to its long-term trend after it has diverged. It takes about 9 years, as you can see, to achieve complete convergence. So the price ratio of stocks to gold can be informative about the future course of the stock market, but it doesn't move very fast. Next slide, please. Many investors think of gold as a risky asset because its price, expressed in paper money, has been volatile in modern times. But this is mostly an illusion due to the instability of the currency. It has long been known that the purchasing power of gold is roughly constant over extremely long periods of time. And thoughtful investors should be treating gold as a very safe asset. By and large, markets do that. Gold also has other kinds of safety properties. For example, the market for bullion is worldwide in scope, and it's very liquid. During the last few months of 2008, while the US economy was on the verge of collapse,